For any investor, one of the biggest challenges is just cutting through all the noise. How do you quickly figure out if a company is financially healthy without getting totally lost in data? Well, today, we're going to look at a tool that promises to do exactly that, an instant, super smart financial checkup.
If you've ever tried to research a stock, you know this feeling, right? You click on a company and bam, you're hit with this tidal wave of numbers and reports. It's a lot. It can be completely overwhelming.
And yeah, this is exactly why. You're supposed to somehow digest more than a decade of profit and loss statements, untangle these super complex balance sheets, make sense of dense cash flow statements, and then calculate and interpret dozens of financial ratios? Come on, it's basically a full-time job. But what if there was a better way? What if you could just cut through all of that and get an expert-level summary in, seconds? Well, that's what we're talking about today. It's a feature called Quick Analysis.
The best way to think about this is like a financial health checkup for a company. The second you open it, you get this really clean, really clear dashboard that just summarizes everything you need to know. It takes all those complicated documents and distills them into one simple, easy-to-understand view.
And this is the very first thing you see, a single number. For this company, it's a 91 out of 100. That's it. No jargon, no complicated formulas, just one score that immediately tells you the story. It's such a powerful starting point that tells you right away if you should dig deeper or maybe just move on.
And this color-coded system is like a universal language for financial health. You really don't need to be an expert to get it. Green, like that 91 we just saw, signals a really strong company. But as you move down into yellow, orange, and red, the system is visually flagging that, hey, there are increasing levels of concern here, telling you exactly where to focus your attention.
So, what exactly goes into that score? Good question. Let's take a quick tour of the dashboard and see how a company's performance really gets broken down. The analysis really zeroes in on 4 critical vital signs. First, return on equity. Is the company using your money effectively? Then debt to equity. How much risk is the company taking on? And finally, revenue growth and operating margin. Is the company growing its sales, and is it actually making money doing it? Altogether, they give you this powerful, high-level snapshot.
And this is where you can see the power of this thing. On the left, you've got our high-scoring company with a clean bill of health, lots of strengths, no concerns. But on the right, a totally different story. A low score of 36, 0 strengths listed, and 2 huge areas of concern flagged in red. In just a glance, you can see the huge difference between a healthy company and one that's facing some serious challenges.
Now, when concerns are flagged, they get automatically prioritized, and this is so key. It helps you immediately see the difference between a critical, high-severity issue in red that you need to look at right now versus a more minor, low-severity issue in yellow that you can just kind of monitor over time. It's all about focusing on what really matters. The analysis also looks at growth over time, using something called the Compound Annual Growth Rate, or CAGR. It shows you the 3-year trend for a look at recent performance, 5 years for that medium-term consistency, and then the 10-year trend to see if the growth is sustainable in the long run. This is so useful for spotting if a company's growth is speeding up or starting to slow down. Okay, so we've seen how the standard analysis works, but here's where it gets even smarter. A good analysis isn't one size fits all, right? So let's look at how this system actually customizes its approach. This is absolutely critical. Think about it. A high level of debt might be a massive red flag for a software company, but it's totally normal for a bank. The tool knows this. It automatically adjusts its analysis based on the company's sector. It's all about applying the right rules to the right game.
And while the sector is usually auto-detected, you have full control. This is really useful for those big conglomerates or companies that operate in a bunch of different industries. You can just manually select the most appropriate sector to make sure the analysis is using the right benchmarks.
Here's a perfect example of why that matters so much. For a bank, high debt to equity and even negative cash from operations is just part of the business model. The analysis knows not to freak out about that. But for an IT services company, oh yeah, those same numbers would be major red flags, and the tool would treat them that way. Context is everything. But it goes beyond just the company's sector. The tool also understands that you have a unique investment style. A value investor is looking for completely different things than a growth investor, and your analysis should reflect that.
So you can actually set what I like to call the difficulty level of your analysis. With just one click, you can pick a preset that lines up with how strict you want the evaluation to be, and it instantly adjusts all the behind-the-scenes thresholds. This lets you line up the analysis with your own philosophy. The conservative preset raises the bar pretty high, filtering for only the most stable, blue-chip companies. On the flip side, the aggressive setting is way more forgiving on current profitability, focusing more on growth potential, which is perfect if you're looking at startups. And moderate is just a solid, balanced approach for most situations.
So let's put it all together. This isn't just about getting a score, you know? It's about developing a smarter, faster process for checking out companies. So here's your action plan.
All right, so to really put this into practice, first, always double-check that the company's sector is correct. Then, match the analysis to your strategy. Are you hunting for value, or are you screening for growth? And if you're comparing two companies, make sure you use the same settings for a fair fight. And finally, always keep a close eye on those growth trends. A declining CAGR can be an early warning sign that a company is losing steam.
Ultimately, a tool like this really transforms financial analysis from something that feels like a chore into a process of discovery. It gives you the power to screen companies quickly, focus your research where it matters, and just make more informed decisions. So, the only question left is, what are you going to discover first?